So hello everyone, thanks Ben and to the rest of the organizers for this very stimulating conference. I'm hoping you won't be too disappointed to know that this work is not specifically about stranded assets. It does share with the debate on stranded assets the interest in trying to understand what the role of monetary policies and financial regulation could be in supporting and managing the transition to a low-carbon economy. So the presentation, the work, this is a paper that is coming out on ecological economics, is focusing on this. The title has to do with carbon pricing because when I started to present these ideas at the LSE around 2 years ago now, the main comment that I received was, well, why would you need monetary policies? Why would you need green financial regulation? You have carbon pricing. Carbon prices will take care of everything. We just need to implement them. So what the paper does is, first of all, to find a sort of theoretical justification of why carbon pricing may not be enough, even when implemented. And in particular, there is some research going on, I will mention it, but my paper focuses on this market failure existing in the process of credit creation and allocation, which may lead banks not to react as expected to price signals under certain macroeconomic conditions. For these reasons, carbon prices may not be enough, and we need to start thinking about additional policies targeting more specifically the credit sector. The second bit of the paper and this presentation is then dedicated to looking at what these additional policies could look like. And in particular, I'm concentrating on a green macroprudential regulation, this idea of using macroprudential financial regulation to actually steer some of the investments towards some of the lending financing investments towards green activities. And in particular, I will concentrate on this idea that seems to be gaining popularity of green differentiated reserve requirements. And finally, what I will do is to discuss whether this is likely to work or not. And the anticipation of the results that we'll get to is that it all depends on where you want to implement this and on the underlying central banking framework. So in high-income countries where everything is about the interest rate, so price is the instrument in the hand of central banks, this is less likely to work than in other developing countries where there's a mix of price and quantity-based instruments. Right, so let me go through all this. Carbon pricing. So investment from a macroeconomic perspective is expenditure, right? So in order to be able to spend, firms typically require external finance. So they don't usually have the money to invest before they invest. They have to obtain external finance from somewhere, and usually this external finance comes from bank lending. It's not the only source of external finance, but it's the most common. So the question that I want to address here is how to convince banks to lend to low-carbon sectors. There's a whole literature on how to convince institutional investors to lend to green sectors. That's not what I want to focus on. My focus is on banks, is on private banks. So the usual answer to whatever whatever this actor is just put a price on carbon. You modify the relative convenience of goods and services, of clean goods and services, which become more convenient than dirty ones, and everything should be fine. Firms go to green activities, banks lend to green firms, and so on. What I'm arguing here is, first of all, very obviously, we don't have any certainty whether the carbon price will be implemented. So you know that both carbon taxes and carbon markets face social and political oppositions. Even when they are implemented, they may not last. That's the case of Australia, for instance, very recently. And even when they are implemented and they last, they might incur in technical difficulties like the European carbon market. Even supposing that there are no technical difficulties, what I argue in this paper is that carbon prices may not be enough even then, and this is because a market failure exists in the credit sector, as I was mentioning before, and banks may decide not to lend to green firms even in presence of a carbon price. And the relevance of this market failure is proportional to the degree of public control that the central bank or in general financial regulators have on the process of credit creation and allocation. Let me go through this. I'm sure some of you, or most of you, will be already aware of all this, but I will go through it quite quickly. So private banks are the only actors in modern economic systems, together with central banks, which are capable of expanding the money supply. And the way they do it, so this is a stylized representation of a private bank balance sheet. You have, is there a pointer in this? No. Well, you have reserves, central bank reserves on the asset side. Reserves are a sort of deposit that banks have at the central bank, very similar to deposits that customers have at the private banks. Then loans appear on the asset side because they're a claim that the bank has towards clients, and deposits appear on the liability side because they're a claim of the client towards the bank. And the difference between these two sides give us the net worth of the bank. So what happens when banks decide to give a loan to a customer? Well, the balance sheet of the bank is expanded in this way. So both sides of the balance sheet are expanded. You have a new loan here, a new deposit here. Forget a moment about constraints on this. I will talk about it in a second. But in general, the main point here is that banks are not financial intermediaries, right? So they're not only financial intermediaries. They don't move someone else's savings to someone else to lend to someone. They create new deposits, okay? And this is how they expand the money supply. This function can be more or less regulated, okay? Some of the instruments to regulate this function are the ones that you see here. So, for instance, all the Basel III regulations, liquidity requirements, capital requirements, or in our case, reserve requirements, which I'm going to focus on in a minute. So, for instance, these are reserve requirements. These are the ratio between central bank reserves and the stock of deposits of a bank. And these are capital requirements. It's the ratio. This is anyway. The asset side on the the capital, the net worth on the overall asset side. This can be risk weighted or not. So, in high-income countries, there is very little control on this function. That's what I am arguing in this paper. Banks can decide credit creation and so how much credit to create and who to allocate it to in a very free way. This creates a misalignment between the legitimate private objectives of banks, which are profit-seeking institutions, and whatever objectives we might have as a society, for which the availability of credit is a precondition. This autonomy also makes them very prone to instability cycles. So this is theory that it has been going around the economic circles for decades now. This idea of Minskian cycles, for which you have both periods of euphoria and then panic. During the periods of expansions, the firms want to invest, prices usually are rising, and banks want to lend. Okay, this is, for instance, what was happening before the financial crisis. And then there is a collapse at some point, and the downturn is characterized by the leveraging of both firms and banks. They want to shrink their balance sheet, get rid of the risky assets, just pass through the tide and survive. So banks constrain credit usually during this period. And this historical period seems to be a good example of this downturn, of this sort of Minskian collapse phase. So here you see these are the nominal rates in some of the major central banks. So after the financial crisis, they went to unprecedented low levels. Aware that this was not really getting where they wanted, they also implemented unprecedented quantity policies. So these are the assets, the balance sheets of the same central banks. You can see that they expanded a lot, and they have never been so big. This had many objectives. One of the main objectives was to revive credit creation by private banks. Okay? Then they also had other issues in mind related to inflation, deflation, or the stability of bond yields and so on. But one of the main objectives was about credit creation by private banks. Did it work? Well, not really, not entirely. So here you can see the same. This is the ECB, and here you have the Bank of England and the Fed. These are the solid lines are the balance sheets of the central banks. You can see that they expanded a lot. The ECB expanded, then shrank, and then now it's expanding again with the Draghi bazooka. But if you see the dotted lines, these are the broad money measures. So everything is equal to 100 in August 2008, and you can see that the dynamics has been rather flat, except for the US, which managed to have some credit expansion, but both Euro area and Bank of England didn't. This is looking more precisely at the UK situation. This is the loans to businesses, and it's been negative since 2009. Okay, so my point here being that despite price instruments, very low price of reserves, very unprecedented quantity-based instruments, banks are just not lending. Okay, whatever the conditions are, however interesting the investment opportunities are, the return rates and so on, they're just not lending. Okay, they're going through a phase of very low confidence, of panic, and they're just coming out, hopefully now, out of this. So during these types of periods, okay, carbon prices may not be enough. The banks don't want to lend, whatever the opportunity of their investment is. They fly to very hyper-secure, hyper-liquid assets, and this seems to indicate that during this crisis, green activities won't really be attractive to them. They don't have particularly high returns. They have very high levels of risk, at least perceived risk. So alternatively, another way to look at this is that the necessary carbon price to overcome all these problems may be high, so high that it becomes politically infeasible. Okay, so probably if a carbon price of $10,000 per CO2 ton is implemented, that might work. Okay, that might give a good incentive to banks, but it will never be implemented. So all this in environmental economics is all about market failures, and so all this to come to this, we need a portfolio of policies to hedge the risk of non-implementation of a carbon price or non-effectiveness of a carbon price, which is a likely scenario under certain macroeconomic conditions. And this is, for instance, some of the, similar to what the World Bank is now saying. This is a very recent report. The World Bank says, so they have 3 steps to a zero carbon future. One of these steps is to go beyond prices. So you see carbon pricing is necessary, but carbon pricing alone cannot solve the climate change, because there's a number of other market failures out there, including a credit market failure that is not, they're not addressed by carbon prices. So what types of policies can we implement then? I'm going to concentrate here on this idea of using financial regulation in order to support and give incentive to banks in order to lend to low carbon activities. In particular, there is this idea of having green differentiated reserve requirements that has been proposed by a number of people, it's still a quite niche debate, but there's a paper by Rosenberg et al. In climate policy, more recently France Stratégie, which is the think tank of the French government, with some quite well-known scholars. They're proposing something similar. They have a different name, but it's basically the same idea. Lebanese central bank is actually implementing green differentiated reserve requirements. And then, as I will show you later, there's a non-green experience of differentiated reserve requirements in China. So the idea is the following. Again, a balance sheet of a private bank, reserve requirements is the ratio between reserves and deposits. So suppose that we have a reserve requirement of 10%, then if the bank is unable to get new reserves, which it usually does, but suppose it doesn't, then it cannot expand its deposit to more than 100, okay? This, of course, has profit implications because the income of a bank comes from lending. So if the lending is constrained, then they're losing potential profits. So now suppose that this is a situation where deposits are 80 and reserves are 10. We implement green differentiated reserve requirements so that if the loan goes to non-green lending, the reserve requirement is still 10%, otherwise 5%. So in this situation, where there's still some operating space for the bank, because deposits are 80 and not 100, the bank has two lending options. The first one is to lend to non-green deposits, get to 100, and stop there, unless, of course, it's able to get new reserves. And the other option is to create new green deposits, so lend to green firms, and given the lower reserve requirement, the new deposits will be equal to 40. So the idea behind these green differentiated reserve requirements is that you can at the same time increase the amount of credit available to the green sector and given a profit incentive to banks because their balance sheet expands.
That's 3 minutes.
Yeah, okay. So these, for instance, are some implementation mechanisms. I'll just skip that, but they're saying the same thing that I said, where there's a central bank that creates green central bank reserves for commercial banks that lend to low carbon entrepreneurs. Then you must have some monitoring unit to decide how much the investment is worth in terms of emissions reduction, and so on. These are taken from the two papers that I mentioned. So, would they work? It depends on where they are implemented. The high-income high-income countries are usually characterized by central banking framework based on the interest rate. So, central banks have the reference interest rate as their sole instrument of policy. In these types of frameworks, these green differentiated reserve requirements, what I am arguing is that they're not likely to work because basically central banks have to accommodate for any demand of reserves anyway, okay? If they want to keep the interbank market rate close to the reference rate, they need to accommodate for any demand of reserves. So in this case, reserve requirements are not very useful, and in fact they have been usually abandoned in many high-income countries. The UK has not, for instance. In emerging economies, on the other side, they usually use a combination of prices and quantities. So they are willing to let the interbank market rate fluctuate more, so the volatility they accept is higher, because they also want to control the quantity of reserves that the banking system has. China is an example. Of course, there are limits to this, as the same China example tells us, with the recent cash crunch and so on. But in general, the control on the credit creation and allocation by private banks is higher. And so these types of policy instruments, green differentiated reserve requirements, can actually be something that give results. Okay, this is just to show you that reserve ratio requirements are actually used in many developing economies. This is China. These are another set of developing economies that have used it as a policy instrument. And this is the Chinese case of differentiated reserve requirements. They're not looking at green versus non-green, but at small versus big banks. They also have preferential lending sectors. So it's something that it's already been experienced in terms of central bank policies applications. It's not something particularly new. Alternative options can be to look, instead of the green differentiated reserve requirements, I actually think I would like to develop some of this in the future, that green differentiated capital requirements could actually be a more useful policy because they're more stringent as a tool. This is, I'm sorry. So this is, for instance, another thing that the Chinese central bank is doing. This is called window guidance. So they basically suggesting gently to the banking sector, of course they have a whole different banking sector, to lend to green sectors. And one final thing that I wanted to mention is the possibility of green quantitative easing. There is, for instance, this precedent in Canada where they had an industrial development bank for many decades. Now it's not operative anymore. But what happened is that this development bank was issuing bonds that were bought by the central bank, and the Canadian, the industrial development bank then, it was lending to industrial projects. So something like this has been proposed as well. For instance, the Green Investment Bank in the UK could issue some sort of securities that are bought by the central bank, and through that money they lend to green activities. Okay, at the conclusions, we need to fill this green investment gap that we're currently seeing. Carbon pricing may not be enough for the reasons I explained, and I think we should start thinking about financial and monetary policies targeting more the private sector. They will tend to work only in certain institutional settings. These are some of the examples in emerging economies. I just want to remind you that the history of high-income countries is also full of quantity-based instruments used by the central bank to have a higher control on the process of credit creation and allocation. And also we're in a very favorable moment because there's a current reshaping process of the central banking mandates, as for instance the Bank of England testifies. And yeah, further research is economic modeling. But yeah, I can come back to this.
Thank you very much.
This is the money flowing.